Most investors focus on profit. They check the bottom line, see a big number, and think the company is winning. They see earnings per share growing and assume everything is fine. But as a chartered accountant, I look at something else entirely. Because while profit is an opinion, cash is a physical fact. You can't pay your employees with earnings, you pay them with cash. By the end of this deep dive, you'll understand how to turn your stock portfolio into a monthly cash flow machine. Let's look at Act 1. To understand covered calls, you have to stop thinking like a gambler and start thinking like a landlord. This is the foundation of the strategy. When you own a rental property, you own the asset. Someone else pays you rent for the right to live there for a specific month. In the stock market, you can do the exact same thing. You own the shares and you rent them out to another investor in exchange for a premium. The first benefit is immediate income. The moment you sell a covered call, that cash, the premium, is deposited directly into your account. It's yours to keep. The second benefit is a buffer. That premium you collected lowers your entry price, giving you a small layer of protection if the stock price dips. Third is discipline. Covered calls force you to set a price at which you are happy to sell, removing the emotional greed that causes most investors to hold too long. Now, before we get to the mechanics, a quick compliance check. This content is for education only and is not personal financial advice. Options involve risk. Let's get into Act 2. How do we actually execute this? There are 3 key terms you must master: the underlier, the strike, and the expiration. First, the underlier. To sell one covered call, you must own at least 100 shares of the underlying stock. This covers your obligation. Second is the strike price. This is the price at which you agree to sell your shares if the stock reaches that level by the expiration date. Third is the expiration. Most investors sell weekly or monthly calls. This is the rental period. Once it ends, you can rent the stock out again. And finally, the premium. This is the rent the buyer pays you today. It is yours regardless of what happens to the stock price. As an accountant, I love this because it adds a second source of return to your portfolio. It's not just about the stock price going up, it's about the income. Now for Act 3, the numbers. Let's look at a real-world profit and loss scenario using 100 shares of a hypothetical stock we'll call TechCorp. You buy 100 shares at $150 each. Your total investment is $15,000. This is your foundation. You then sell a $160 strike call expiring in 30 days. You receive $300 in premium immediately. Your cost basis is now effectively $147. Let's look at scenario A. 30 days pass and the stock is at $155. It's up, but it's below your strike price. What happens to your P&L? The option expires worthless. You keep the $500 in stock gains and the $300 in rent. Total profit, $800, and you still own the stock. Now, scenario B. The stock moons to $170. This is the scenario that confuses most beginners. As an accountant, here is the math. Because you sold the right to buy at $160, your shares are called away. You make $1,000 on the stock and keep the $300 premium. Total profit, $1,300. But here's the catch. The stock is at $170. If you hadn't sold the call, you would have made $2,000. You traded that extra $700 for the $300 rent. Finally, scenario C. The stock drops to $140. This is where the protection benefit comes into play. Let's look at the numbers. The stock is down $1,000, but because you collected $300 in rent, your net loss is only $700. You are better off than if you had just held the stock alone. This leads us to Act 4. In every covered call trade, there are 3 logical paths. Understanding these is the difference between a pro and an amateur. Outcome 1. The stock stays flat. This is the ideal scenario. You collect rent month after month, effectively creating your own dividend. Outcome 2. The stock goes up past your strike. You are forced to sell. You've hit your max profit and you move on to the next opportunity. Outcome 3. The stock trends down slowly. Your income cushions the blow, but it doesn't stop the loss. This is why you must only do this on stocks you want to own. Act 5. Most gurus only talk about the income, but as an accountant, I have to talk about the trade-offs. There is no free lunch in finance. The biggest risk is not losing money. It's losing out on massive gains. If your stock doubles overnight, you don't participate. You are capped at your strike price. For many growth-focused investors, this locked upside is a deal breaker. You are trading the chance at a home run for the certainty of a base hit. The second truth. you still have full downside risk. If the stock goes to zero, your $300 in rent won't save you. You are still a shareholder. A covered call is not a hedge for a market crash. It is a slight cushion, but in a true bear market, you will still see red in your portfolio. And here is the accountant's perspective. The tax trap. Selling calls can trigger capital gains taxes sooner than you planned if your shares are called away. If you've held a stock for 11 months and it gets called away, you pay the higher short-term tax rate. Always look at your P&L after tax before you celebrate. So when should you use this? This is Act 6. There is a time to collect rent, and there is a time to let the asset grow. Let's compare. Best use case. A flat or slightly bullish market. When the world is boring, covered calls are the only way to beat the S&P 500. They are an income investor's dream. Another great use, when you already plan to sell. If you want to exit at $160, why not get paid to wait for the stock to get there? It's a smarter way to sell. Worst use case, high growth, volatile stocks. If you sell calls on the next Tesla or Nvidia, you will likely get left behind during a massive rally. Don't cap your best assets. And don't use them to save a crashing stock. If the business is failing, sell the stock. Don't wait for a tiny premium while the asset loses 50% of its value. Before you place your first trade, here is your definitive checklist to ensure you are thinking like an accountant and an investor. Step 1. Verify you own at least 100 shares. Selling a call without owning the shares is called a naked call, and that is how accounts get wiped out. Step 2. Ask yourself, am I genuinely happy to sell my shares at this strike price? If the answer is no, do not sell the call. Emotion is the enemy of profit. Step 3. Pick your duration. Monthly calls generally offer a better balance of premium and flexibility. Don't get greedy with short durations unless you are a pro. Investing is about systems. The covered call is a system to extract cash from the market while maintaining your assets. It is the core of evidence-based wealth building. Stop treating the market like a casino. Treat it like a utility. Use your assets to generate power, in this case, purchasing power. That is how the wealthy grow. If you found this 8-minute deep dive valuable, you are starting to see the market through the eyes of an accountant. You are looking at the facts, not the hype. I'm the Accountant Investor. Subscribe for more masterclasses on options, financial analysis, and wealth building. Let me know, what stock are you renting out right now? This content is for educational purposes only and should not be considered financial advice. Options involve significant risk and are not suitable for all investors. Learn investing through the eyes of an accountant. I'll see you in the next masterclass. Stay logical, stay evidenced, and keep building your monthly cash flow.